Hi, Tony Daly, and I wanted to share with you a broken missing leg put side iron condor trade that I taught last night and showed you. The instrument that I've chosen is the FAS, which is the Direction Shares Financial Bull Triple. And if we take a look at the daily chart, I always kind of do the technicals first. It seems like we have a big wedge building in. We're kind of in the middle of the wedge here. We have an upper limit and a lower limit fairly defined. Looking on the daily chart, looks like we broke through and we've had some follow through to the upside. JP Morgan has already announced, and that's out of the way. JP Morgan and Wells Fargo, we got to get through Bank of America and Goldman Sachs, but I'm expecting a mild beat on both sides. I don't see anything spectacular happening with the financials with what's looming around us, so I think this is a fairly decent trade. In any event, going to the Analyze tab, we take a look at my initial criteria for SAS. I'm going out to the FAS, we're going out to the November, 35 days out. Looking at my first criteria, you remember current IV percentile is 50%, the IV low is 37, the IV high is 67 for the entire year. Current IV is 52. Is that high or is that low? Well, it's relative to itself and it's right at the 50% mark. So that meets our criteria. It's premium rich, and we're okay to put on some short options. So that being said, let's take a look and see what we got. We talked about looking at the 25 delta. So here I have a 24, and I basically put this on when it was a 24. Now it's a 28. But anyway, I put on the 78, 79 bear call. So we're about 7 points out of the money. It's a 28 delta now. Was a 24 when I put it on, like I said. But anyway, the credit that we collected on that was 22 cents. So our risk is $1 minus 22 cents or 78 cents. So according to the rules on my put, I have to collect at least 78 cents to remove the upside risk. Well, if we go to the 25 delta, which is now 22 delta, it's 168 to 173, but I collected $1.82 when I put it on. So I have the 64 short put, and I have the 78.79 call spread. I collected a total of $2.04. I put on two of them, so 204 times 2 is I collected $408. My risk on the downside is $78. So basically, I have a nice credit to the upside, and I have no upside risk. And that's the goal of this strategy. So what does that really mean? That means that at November expiration, if FAS is trading at 80, which is beyond the short strikes, I have no upside risk because I'm only obligated for the $78. Meanwhile, remember, I collected 204. If FAS goes to 100, it's the same thing. I make money. If FAS goes to 1,000, I make money. If FAS is between 78 and 64, which is my short strikes, then it behaves just like an iron condor. I would keep the entire $408. If it goes below 64, I would be obligated to acquire 200 shares of FAS, or I could simply close and roll the position down or do whatever I want. But really, that's my only risk, and that is anybody's only risk when you do any type of uncovered short strategy. If you wanted to be a little bit more conservative, you could go further out of the money and put on some protection, even if you go down to the 59, just as long as your total credit will offset the width of your short bear call. That's your criteria. You only want risk below the short strike of your put, which gives you a wide range of profitability. And as I showed you yesterday, this has about a 90 to 92% win rate. So It's pretty good. It's one of my real go-to strategies over here. And again, for me, the secret sauce is to make sure that you are starting out with rich volatility at 50% or above. Okay, thanks. Hope you enjoyed it. If you have any questions, let me know. And I'll see you next time around, and we'll take a look at this one and see how we're doing. Thanks. Bye.